Let me get this stream out here. Let's see. What's going on, guys? I just got to set a couple things up. Live stream. There we go. Come on, man. I suck at this. Damn it, I'm not here. Live stream. Let's see if that works. Let me put this on stock Twits. Get rid of that. Yo, what's up, guys? Sorry, I was messing around. Trying to post on Twitter and stock Twits. Hang on, I still gotta post on a couple things. Okay, let's see. I suck at lives. Let's see. Come on, baby. Come on. Oops. Hey, if you guys can post this in stock Twits, because I'm sure a couple of people in there that might not follow me, just post it on stock Twits a couple of times. What's going on? Okay. I wish I could have got on a little earlier because the earnings call starts in like 5 minutes. But I was trying to just read up, trying to set the live stream up a little bit. But I was reading through the earnings, and remember, guys, if you've been following me on Twitter, I said I'm looking for 1.6 billion in revenue with, these partnerships and stuff. They guided for 1.57 billion. So I was pretty close. But listen to me real quick. They would have easily blew out this 1.57 if student loans were back 2 years ago, a year ago, guys. That is, additional 100 million, maybe 200. I'm not exactly sure, but I think it's like 100 million, for a full year, like of revenue they're missing out on. So the guidance should have easily been over 1.7 billion. If you look at their investor presentation, it was 1.5 billion back in 2020. So guys, they are above schedule. They are doing way better than they expected, even with student loans pushed back. I did say the Ebitda projection that they put out was not going to happen. The reason for that is because the bank charter didn't come, when they thought it was going to come, possibly 2021. So they got the bank charter in February or something like that. And then it takes like another month to digest and get it started. So I think they got it for $200 million in Ebitda. I thought they were going to put out about 390, but I just think, they might be lowballing a little bit. So Ebitda might get into 350 million range. That's a possibility, but everything looks extremely solid. Okay. Q4 wasn't a blowout, for revenue or anything like that, because they're still digesting the student loans. They had a nice little, I think it was like a 55% revenue growth. It was like 285. So the revenue wasn't a blowout. I thought they were going to definitely beat EPS. They beat EPS by a penny. I put out a couple of things on Twitter. You guys saw. I said losses should come in right around 130 million from the estimates with all the outstanding shares. The loss was like 110 million, so they beat on EPS. And I think we're going to see losses drop dramatically with this bank charter license. Okay, so I really didn't have a lot of time to read up on, all of the numbers and stuff like that. But guys, they have a lot of customers that they are adding. They could potentially monetize. They wanted to put out 3 million members for 2021. Guys, it turned out to be like 3.5 million. So that's awesome. That's awesome. Stock is up right now. It's up about 16.5%. I think we can go higher if investors hear what they want to hear on this earnings call. We could go higher tomorrow. We could go higher throughout the week. I think we will get higher price targets. And I know this environment sucks. That's why the price targets have been cut. But everything looks really, really good from what I was looking at. I'm going to have to just keep reading. But member growth, amazing. EPS right in line. The guidance, guys, look at the guidance, the full year. You'll see that on my thumbnail. 1.57 billion. That is freaking awesome. That's 57% growth. If you look at a company like Zoom that just blew out, 2020, they blew out 2021. Zoom was growing so fast that they put out, 10% growth for 2022. And that's why you saw the stock dip a little bit even after the 70% dip. So 10% growth compared to a company, 60% growth. That is a big, big difference. So let me keep. What time is it? 5? Oh, they should be starting this call very soon. Holy crap. Okay, let's try this again. I messed up on Twitter. Yeah, if you guys could, share this on StockTwits, that'd be cool. That'll definitely get this live stream, jumping a little bit more. Let's see. They might start at 5:15. I don't know. Sorry, I haven't read any comments yet or anything. Let's see. Come on, man. I suck at this. Holy crap. Dude, sending out all these attachments is so confusing. Oh my goodness. There we go. Forgot to tag the hashtag Sofi on Twitter so it didn't get any
Ladies and gentlemen, thank you for standing by. The conference will begin in 2 minutes time.
2 minutes.
Again, thank you for standing by. The conference will begin in 2 minutes time.
2 minutes. Okay, guys. So I wish I could have got on a little earlier to talk, but we'll go through all of these comments, after the earnings call. We might not listen to the full earnings call, but I just want to get a little bit of an understanding of, what's going on for 2022. Okay. Student loans come back. We're going to increase our guidance and stuff like that. I want to hear this stuff. So I want you to know, guys, the short interest, it has doubled since the Q3 earnings. It went as high as 23 to 22%. It did back off a little bit the last week to 16 to 17%. But I want you to know that the short interest is still ridiculous right now. That's why I think we're seeing a gradual little pump after ours. So the short interest is still ridiculous. Just so you guys are aware of that. It is still ridiculously high. So and understand, Q4 earnings has been terrible for technology and fintech. I've followed about 15 of these stocks, watched all the earnings or read up on all the earnings, and I think there's only been 3 out of the 15 to blow it out. Upstart, Square, I think there was another one. Affirm, terrible. Robinhood, terrible. Lending Club, decent. Guys, this management team, give them their student loans back. What if they got their bank charter 4 months ago? Everything would have been way ahead of schedule, okay? Everything is falling into place. The stock is massively oversold. I really think we're going to have, profitable quarter, I think, is Q2. I think we can have a profitable quarter in Q2 when the bank charter has a full 3 months. Remember, Q1, you're only going to get maybe a month or a couple of weeks with this bank charter. So everything is still behind schedule. That's why the EBITDA was about 200 million on the report that I read. Okay. So they put out for full year 400. It would have likely been 400 million in EBITDA if the student loans were back and they got the bank charter in January. So guys, everything is not SoFi's fault right now. Okay. Numbers are still impressive for what they were, given. Okay. So remember that. What's going on? What's going on? I'm all the way there. Appreciate it. I like the long sleeve. He's not surprised they beat 20 or bust. I think this stock should be $20 at least, in this environment. I know a couple of people got mad at me talking on the earnings call, so I won't talk.
Thank you for attending today's SoFi Q4 2021 earnings conference call. My name is Sam, and I'll be your moderator for today's call.
Can you guys hear?
All lines will be muted during the presentation portion of the call, with an opportunity for questions and answers at the end. If you would like to ask a question, please press *1 on your telephone keypad. At this time, I would now like to turn the conference over to our host, Andrea Krokniak, VP of Investor Relations. Andrea, please proceed.
Thank you, operator, and thank you all for joining us today for SoFi's fourth quarter 2021 earnings call. Joining me today are Anthony Noto, SoFi's CEO, and Chris Lapointe, SoFi's CFO. They will share prepared remarks regarding the quarter's results and then take your questions at the end. Just after market close today, we issued a press release announcing SoFi's fourth quarter and full year 2021 financial results. Our discussion of our results today is complementary to the press release, which is available on the investor relations page of our website, investors.sofi.com.
I think CNBC won't let Liz Young pump SoFi.
Live,
I swear.
And will be available as a replay for 30 days, beginning about 1 hour after the conclusion of this call. There's also an accompanying investor presentation on our IR page. During the course of this conference call, we may make forward-looking statements based on current expectations, forecasts, and projections as of today's date. Any forward-looking statements that we make are subject to various risks and uncertainties.
Smash the like button if you can find it.
That may cause actual
Smash the like button.
To differ materially
I don't know where it's at online.
Included in the statements. We discuss these factors in our SEC filings,
somewhere. I don't know where it's at.
Including our 2021 Form 10-K, which can soon be found on the IR page of our website and the SEC filings website, sec.gov/EDGAR. As a reminder, we are not required to update our forward-looking statements. In our presentation today, unless otherwise noted, we will be discussing adjusted financial measures, which are non-GAAP measures that we believe are meaningful when evaluating the company's performance. For detailed disclosures on these measures and the GAAP reconciliations, you should refer to the financial data contained within our press release, which is also posted to the IR page of our website. Today's discussion will focus on both the fourth quarter and full year 2021 results.
I think the calls are an hour.
As always, we encourage you to evaluate SoFi's performance on an annual basis, as quarterly results can be affected by unexpected events that are outside our control. Now I'll turn the call over to Anthony.
Thank you, Andrea, and good afternoon, everyone. Before beginning my prepared remarks, I wanted to take a moment to recognize the unacceptable tragedy that is currently taking place in Ukraine. It's been truly difficult to watch this series of events unfold over these past few weeks and escalate in recent days. No one should have to live in fear or under the threat of violence, which has now become a reality. Our hearts go out to everyone directly or indirectly affected by this tragic situation. Now on to our results. We had another strong quarter hitting new highs across our key financial and operating metrics and finishing 2021 with record annual results. Today, we're in our best position ever to achieve our long-term strategic goal, to be the digital one-stop shop for the major financial decisions in our members' lives and all the moments in between. Here are some of the highlights. Record fourth quarter adjusted net revenue of $280 million was up 54% year over year and increased sequentially from a very strong third quarter.
Solid.
Despite the unexpected federal student loan moratorium extension at quarter end.
There you go.
All three of our business segments achieved higher year-over-year growth. We delivered record full-year revenue of just over $1 billion at the high end of our guidance, which we increased on our third quarter earnings call. We achieved our sixth consecutive quarter of positive adjusted Ebitda at $5 million and delivered on our goal of positive full-year Ebitda. We had an amazing quarter for member growth. We added 523,000 new members in the fourth quarter, a record in absolute number terms, and impressively up 39% versus the amount added in the third quarter.
Sequential.
As a result, we ended 2021 with 3.5 million members, an increase of 1.6 million, up 87% year over year, and well above the 3 million member target set in January of 21.
That's crazy.
We also set another record with new product adds of 906,000 in the fourth quarter, up an incredible 51% versus the number of third quarter adds. We finished 2021 at 5.2 million total products, more than double the 2.5 million we had at year-end 2020. And at Galileo, we grew enabled accounts 67% year over year to 100 million. We were able to achieve these milestones in 2021 and get to such a position of strength today for three main reasons. First, we continue to drive strong growth through great execution across our three diverse businesses, which reflects our ability to capitalize on changing macro conditions. Second, the success of SoFi's unique financial services productivity loop strategy accelerated as we scaled our business in 21, which allowed us to exceed our original 2021 member growth target by 40%, and importantly, still hit our Ebitda target. And third, we took a giant step forward in 2021 in achieving our goal of becoming a household brand name via our SoFi Stadium affiliation, the success of our integrated multimedia campaigns, and the virality of the influencers we partnered with. I'll take these points one by one, starting with number one, how we drove strong growth through great execution across our three diverse businesses. In lending, we grew segment revenues by 30% year over year in the fourth quarter and 42% for the full year, even with the unexpected extension of the federal student loan payment moratorium in late December. Fourth quarter personal loan originations were a record of $1.7 billion, up 168% year over year, and more than double fourth quarter 2019's pre-pandemic total. Full year originations were more than $5.3 billion versus $2.6 billion in 2020 and $3.7 billion in 2019. Personal loans outperformed as a result of our improved execution, enhancements to our technology and credit models, and the quality of our loans. And through our lending as a service partnership with Pagaya, we added nearly 7,700 referred loans across a broader audience while maintaining our credit criteria.
That's only a month partnership.
In home loans,
1 month.
we met our 2021 goals to diversify into purchase loans from predominantly refinanced loans and to re-enter the jumbo loan market. By the fourth quarter, we had increased purchase home loans from low single digits to low double digits as a percentage of SoFi's total home loan volume. And we relaunched jumbo loans in the second half of the year. This diversification will help drive continued growth in a rising rate environment. In student loans, we saw accelerating demand in the fourth quarter ahead of the January federal student loan payment moratorium deadline and anticipated rate increases in 2022. We originated nearly $1.5 billion in loans, up more than 50% sequentially, even with the surprise late December extension to May 22, which caused a reduction in demand during the final week of the quarter. Looking ahead, we expect continued strong growth in lending, driven by our ongoing momentum in personal loans, the end of the student loan payment moratorium, better positioning in home loans, and the many opportunities our new bank license presents. In financial services, we achieved record growth in products adopted in the fourth quarter, and importantly, a large step up in monetization that drove record revenue up nearly 2x sequentially. We added 857,000 new financial services products in the fourth quarter, up 56% from the number of third quarter adds. For the year, we added nearly 2.5 million new financial services products, more than double the 1.2 million we added in 2020. Through better monetization, we produced a 5x year-over-year increase in our fourth quarter total financial services revenue of $22 million, as well as our full year revenues of $58 million. Product improvements that drove the year's phenomenal growth include the following. In SoFi Invest, we gave members more selection and new features. We added 25 new cryptocurrencies, making SoFi a selection leader with 30 at year end. We offered 2 regular way IPOs to retail investors in the fourth quarter. The first was Rivian, the largest IPO since Facebook in 2012. And the second was Nubank, a leading fintech company in Brazil. We introduced stop limit trade orders in the fourth quarter and margin trading earlier this year. At SoFi Money, we introduced 2-day early paycheck, autosave, cashback, and no-fee overdraft protection. And with our launch of SoFi Checking and Savings, we now offer members 1% APY, 33 times the national average, plus no account fees or minimum balance, plus many of the free features members already enjoy.
Let's go.
Our SoFi credit card, which includes the only rewards platform that gives points for both transactions and smart financial behaviors, really took off in its first full year. Quarterly spend, balances, and accounts grew at high double-digit rates, and we finished 2021 with 91,000 products and a debut NPS score in the mid-50s. Finishing with our tech platform, Galileo benefited throughout 2021 from growth in enabled accounts, transactions per account, and adoption of new products by existing partners, as well as the addition of diverse new partners. Fourth quarter segment revenues of $53 million was up 42% year over year, an acceleration versus the year-over-year growth in Q3 at 29%. And with the inclusion of a full year of Galileo results, 2021 revenue more than doubled to $195 million. Galileo added 11 million new end user accounts in the quarter, a 67% year-over-year increase to 100 million at year end, up from 60 million enabled accounts at the start of 2021. Galileo launched some clients and signed 9 new ones in the fourth quarter, bringing total full year adds to 44. We also grew Galileo's total B2B client base by 40% in 2021. We launched Toast last year and signed.
Guys, if you're new to the channel, I did not BS these past couple of months. I told people I really think 1.6 billion is a possibility. I'm not here pumping BS numbers, 1.8 to 2.2 billion in revenue or anything like that. I literally was $30 million off of what I thought. And that 1.57, look what it's doing. I mean, the stock's surging. So these are the numbers that investors wanted to see. So just remember that. Very close.
Core banking platform. Adding Technisys is the next step in vertically integrating SoFi's businesses to further accelerate the pace of innovation of our best-of-breed financial products. We expect Technisys to be a growth multiplier for both SoFi and Galileo, in addition to realizing its own enormous growth opportunities, which are further strengthened in partnership with Galileo. We are well on our way to building the AWS of FinTech. Now let's talk about point number 2. The success of SoFi's unique financial services productivity loop strategy. Critical to the FSPL is creating best-of-breed products that build trust and reliability with members, which increases the likelihood they choose SoFi for a second or third product. When they do, we benefit from increased LTV per member by generating more revenue at little to no incremental customer acquisition cost. As a result, our higher LTV allows us to invest in more differentiated products and services, which in turn drives more demand and higher LTVs.
No real estate.
It's a true competitive advantage.
That's the key.
The FSPL has had its biggest impact yet on 2021 results.
It's pointless.
The scale of our top of the funnel products is now large enough that at the same cross-buy rates, fourth quarter cross-buy volume more than tripled year over year to more than 380,000 products. And more than 1/3 of our new products were adopted by existing members in the quarter, contributing to the 17% decline in our customer acquisition costs in 2021. I mentioned that our total year-end members of 3.5 million exceeded our 2021 goal by 500,000.
God, that's the best.
Our unique FSPL advantage not only helped us exceed this goal, we did so without
400,000
associated marketing costs. Instead, these
400K
FSPL efficiencies allowed us to significantly exceed our member and product goals, yet still achieve our EBITDA targets. This brings me to my third key success factor for 2021. Our ability to drive a dramatic increase in SoFi's unaided brand awareness, the unmatched reach of SoFi Stadium nationally televised games, the success of our various integrated multimedia campaigns, and the variety of the influencers we partner with. Here are a few remarkable stats. The 5 nationally televised regular season games at SoFi Stadium were seen by an average of more than 22 million households per game, resulting in a household reach of 110 million plus households in total. This visibility helped increase SoFi's unaided brand awareness by nearly 70% in 2021 to a new record in the fourth quarter. And that was before an estimated 106 million people tuned in to watch the Rams win the Super Bowl at SoFi Stadium. Before turning it over to Chris to talk through results, I wanted to share a few additional thoughts. In February, I celebrated my 4th anniversary as the CEO of SoFi. While I could not be more proud of all we've accomplished in such a short period of time,
they didn't BS
I'm even more excited about what's ahead of us. We are just starting to reap the benefits.
Remember, guys, SoFi didn't go public at a BS time, pre-revenue, no revenue. Like, Lucid just cut their full 2022 numbers, They went to the market at an incredible time where the company is thriving. Super Bowl. I mean, this is probably in the top 2, top 3 SPACs, out of all 1,000 SPACs. They could have easily went the IPO route. I'm just telling you that. They went to the market at a perfect time. Noto took 3 years before he went public.
By delivering record quarterly revenue
3 years he waited.
in our 6th consecutive quarter of positive EBITDA.
That's important.
Importantly, we achieved this despite facing new and existing challenges in the quarter, proving once again that our diversified and differentiated business model drives SoFi's durability and long-term growth potential. I'm going to walk you through some key financial highlights for the quarter and year, and then share color on our financial outlook. Unless otherwise stated, I'll be referring to adjusted results for the fourth quarter of 2021 versus fourth quarter of 2020. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and our 10-K filing. For the quarter, top line growth accelerated as we delivered record adjusted net revenue of $280 million, up 54% year over year from the same prior year period, and at the high end of our guidance of $272 to $282 million. Adjusted EBITDA of $5 million was also at the high end of our guidance of $2 to $5 million. For the full year, we delivered $1.01 billion of adjusted net revenue, up 63% year over year. Our original 2021 plan and what we guided to during the IPO process was $980 million in adjusted net revenue. That assumed the federal student loan payment moratorium would expire on September 30th, 2021, and also included a full year of revenue recognition from our equity investment in Apex, which was called last January. Despite the 50 million plus of revenue headwinds created by those two factors alone,
50 million.
We still exceeded our original revenue plan by $30 million. From an adjusted EBITDA perspective, we delivered $30 million in profits above our original full year guidance of $27 million and up $75 million from the $45 million of losses incurred in 2020.
Now on to the segment level performance, where growth accelerated across all three segments. In lending, fourth quarter adjusted net revenue grew 30% year over year to $208 million versus 21% in Q3 of 2021, driven by a 67% increase in funded volume to $3.8 billion in total, a new high for us. The largest contributors to funded volume growth were our personal loans business, which grew 168% or $1 billion year over year to $1.6 billion in originations for the quarter, and our student loans business, which saw more than 50% year over year growth to $1.5 billion. In personal loans, we captured increased demand from borrowers remodeling their homes and refinancing variable rate debt into attractive fixed rate products as interest rates increased. Additionally, we continue to improve conversion as we iterated throughout our funnel. In student loans, we benefited from increased demand from federal student loan borrowers looking to refinance prior to the anticipated January 2022 expiry of the federal student loan payment moratorium. In addition, increased net interest margins and strong gain on sale margins, inclusive of hedge gains, drove material year-over-year growth in net interest income and loan sales revenue. The lending business delivered $105 million of contribution profit at a 51% margin. Overall contribution dollars were up 23% versus the same prior year period, but margins were down from 53% in Q4 2020. The slight year-over-year decline in margins was caused by lower home loans throughput with our third-party fulfillment partner, resulting in lower home loans revenue and margins. I'm pleased to say demand remained robust throughout the quarter, and were it not for these partner issues, we would have had strong quarterly performance. These issues have since been resolved by onboarding another third-party fulfillment partner. In addition, expenses were higher in the student loan refinancing business, where we increased marketing to capitalize on elevated demand in the lead up to the January 2022 federal student loan payment moratorium expiration. When the moratorium was unexpectedly extended to May 2022 at the end of December, we lost a week of revenue from anticipated federal student loan funding and had already spent the marketing dollars. For the full year, lending adjusted net revenue grew 42% to $764 million, and the segment delivered $400 million of contribution profit at a 52% margin. Shifting to our tech platform, where we delivered net revenue of $53 million in the quarter, up 42% from the same prior year period. Overall segment growth was driven by 67% year-over-year Galileo account growth to 100 million in total. As a reminder, it is normal to see a lag between the addition of new accounts and the engagement and monetization of those accounts. We are encouraged by this leading indicator of Galileo's growth. Q4 contribution profit was $20 million at a 38% margin, which is down year over year given the investments we have made in technology capabilities overall and the migration to the cloud, but up sequentially from 31% in Q3 2021 due to fixed cost leverage we were able to achieve in the quarter. This one quarter does not mark the beginning of a trend, and as discussed previously, we plan to operate the business in the 20 to 30% contribution margin range for the foreseeable future as we continue investing to take advantage of the opportunity ahead of us. For the full year, the tech platform segment grew revenue 102% to $195 million and delivered $64 million of contribution profit at a 33% margin. Onto our financial services segment, which continues to benefit from strong growth across all products and our improved ability to monetize that growth. This segment delivered revenue of $22 million in Q4, more than 5 times the prior year quarter at $4 million, and up 74% sequentially. Within the segment, year-over-year revenue growth was particularly strong in SoFi Invest, Lantern, SoFi Credit Card, and SoFi Money. As important, our year-over-year revenue growth was twice our exceptional product growth of 2.5x, demonstrating our continued progress in monetization. Invest added 362,000 accounts and reached 1.6 million in total. Money added 276,000 accounts and reached 1.4 million in total. And Relay added 180,000 accounts and hit 930,000 in total. Contribution losses were $35 million for the quarter. While this is a slight improvement year over year, we remain in investment mode, focused on creating the right unit economics for each business to drive long-term sustainable growth. For the full year, segment revenue of $58 million was nearly 5x the $12 million we delivered in 2020, and our $135 million contribution loss was essentially flat year over year. Quickly switching to our balance sheet, which grew by approximately $600 million year over year to $9.2 billion in total, primarily as a result of growth in originations that accelerated in the back half of the year. In addition, we exited the year with $1.6 billion drawn on our warehouse facilities, less than 25% of our overall $7 billion of capacity. That low reliance on warehouse capacity allowed us to significantly reduce our cost of funds, and we ended the year very well capitalized, having raised a total of $3.6 billion of new capital. Our total book value is $4.7 billion, and our capital and leverage ratios are extremely strong. Finally, on December 6th, we redeemed all of the outstanding SoFi Technologies private and public warrants, which removed a significant source of P&L volatility for SoFi. We are excited about the strength of our balance sheet and will continue to make choices that ensure the most efficient cost and use of capital. The last thing I want to discuss is Q1 and full year 2022 guidance. It's important to note before getting into the details that the incremental net interest income from SoFi Bank will only contribute nominally to Q1 results and prior to fully originating loans in the bank, which we expect in May of 2022. That's because when we opened the bank in February, we did not contribute any existing SoFi loans to the bank as we initially capitalized the bank with cash. We are still transitioning our operations to have loan originations occur from the bank, and that transition will not be fully complete until the end of May.
Oh, there you go, guys.
Over the last several quarters, our unique, diversified business model has proven to be an increasingly powerful competitive advantage. Even as we continue to invest in scale, we expect that strength and momentum to continue. Our Q1 guidance incorporates the negative impact of the unexpected extension of the federal student loan payment moratorium to May of 2022. We estimate that negative impact to be approximately $30 to $35 million of revenue and $20 to $25 million of contribution profit in Q1, with loan origination levels for the entire quarter to be consistent with those of the first 3 quarters of 2021.
God, makes me mad.
For Q1, we expect $280 to $285 million of adjusted net revenue, up 30 to 32% year over year, and $0 to $5 million of adjusted EBITDA. Had the moratorium expired in January, we estimate that Q1 revenue would have been $310 to $320 million, and EBITDA would have been $20 to $30 million. For illustrative purposes, we've included this alternative scenario in our investor presentation.
So stupid, man.
For the full year 2022, we expect to grow adjusted net revenue 55% year over year to $1.57 billion and deliver adjusted EBITDA of $180 million.
180 million EBITDA.
There are several recent developments that factor into our full year guidance.
That's good.
First, we assume the moratorium on federal student loan payments expires as currently contemplated on May 1st, 2022, and student loan refinancing origination volume will normalize at pre-COVID levels partway through Q2 and remain at those levels from that point through the remainder of the year. Second, we assume the SoFi Bank will begin contributing to SoFi's results more meaningfully in Q2 rather than in Q1 when we open the bank. That's because, as I just mentioned, we opened the bank with no loans and initially capitalized it with cash from our balance sheet. This is an important distinction because we won't begin to realize the lower cost of capital benefits of the bank until we can originate and fund loans in the bank. And we believe it will take until Q2 to build the appropriate loan balances to see more than a nominal impact. Third, we assume that Technisys revenue growth will be 20 to 25% for the full year and start contributing to our business following the close of the transaction. And fourth, as discussed previously, we expect our core SoFi business, excluding the impact of Technisys, to deliver incremental EBITDA margins of 30% in 2022 as we continue investing to drive sustainable growth for years to come. Technisys will contribute a small amount of EBITDA in 2022, but as we mentioned last week, 2021 was a year of significant investment for Technisys. Over time, we expect this business to be additive to consolidated incremental EBITDA margins. The last thing to cover on guidance is our stock-based compensation expense, which we currently forecast to be between $80 and $85 million in Q1 and $340 million for the full year. In summary, we could not be more proud of the results SoFi delivered in 2021. We exceeded $1 billion in annual revenue and delivered a full year of positive EBITDA. We continue to be extremely well capitalized and are excited about the opportunities in front of us. We look forward to another strong year in 2022. With that, let's open it up to questions.
Thank you. We will now begin the Q&A session. If you'd like to ask a question, please press star 1 on your telephone keypad. And if you'd like to remove that question, press star 2.
SoFi should be
As a reminder, if you're using a
$20
speakerphone, please remember to pick up your handset.
now.
Please limit your questions to one question and one follow-up so we can
Growth is
accommodate as many
ridiculous.
participants as possible. You are welcome to rejoin the queue by pressing star 1. We will now take our first question from the line of John Hecht of Jefferies. John, your line is connected. Please proceed.
Thanks very much. A nice quarter, guys, and thanks for the detailed guidance. Very good member and product numbers for the fourth quarter. Maybe can you give us color on what drove that in terms of customer acquisition channels,
Credit card,
customer acquisition costs, any change there, and where you're seeing opportunities and so forth?
credit card, really kicking in.
Thank you, John. So it was an extraordinary quarter for member and product growth, and it's the culmination of a lot of hard work that's gone into the company over the last 4 years. Everything from the member home feed in the app to developing a use of data to make recommendations to our members based on their information and other members' information in a personalized way, a referral program, a rewards program, and then of course, just differentiating the products individually themselves. And then layered on top of all that is just the hard drive that we've made to increase unaided brand awareness. As a financial services companies, our members need to trust us. We need to become a household brand name, and the ability to leverage the broad reach that we talked about in our prepared remarks of SoFi Stadium throughout October, November, December really gave us a nice lift in unaided brand awareness, which makes all of our marketing more efficient. The combination of that and the product differentiation that we've added as it relates to products like SoFi Money and SoFi Invest, which I talked through in the quarter, really drove a really strong growth rate across both members and products. And importantly, at a decreasing customer acquisition cost. I'll let Chris talk to the specifics of the decline in customer acquisition costs on a per member and per product basis. But it was really the culmination of product, marketing, operations, and just a really strong integrated campaign across traditional media, digital, and social influencers.
Yeah, thanks, John. So if you look at Q4 2021 total sales and marketing divided by new members, you'll see that our overall sales and marketing per new member was down nearly 20% sequentially. And if you look at this on a full year basis, it was down about 18% when comparing it to full year 2020.
Okay, that's great. Thanks for that color. And then second question, and I know, Chris, you talked about the contribution from the bank over the course of the year, but maybe can you give us kind of an idea of, as rates move during the year, what that does to the kind of context of the revenues and expenses coming out of the bank, just assuming we go through a rate hike cycle?
Good question.
Yeah, absolutely. I can address the overall question on rates. But what I would say is that our current guidance contemplates 5 rate hikes in 2022. That's roughly in line with what's implied by the forward curves today. And as a reminder, at a high level for the lending business overall, we seek to maximize profit dollars in our lending business while staying within the 40 to 50% contribution margin range that we've talked about historically. In Q4, we delivered $105 million of contribution dollars at a 51% margin across our entire portfolio, even as rates increase. And we expect to maintain this type of approach going forward, even with the bank. As you know, you can't really look at rate volatility in isolation, as we have a number of levers that we can pull to moderate the impact of interest rate movements, such as pricing, the structure of our loan sale agreements, and hedging. From a pricing perspective, we've worked really hard over the course of the last several years to build the muscle and pricing capabilities to react really quickly to changes in rates and achieve our overall margin objectives. In Q1, we've started to increase our weighted average coupon in order to keep pace with rate moves.
and offset the impact of margin compression that's expected. And demand has remained fairly robust, specifically in our personal loans business. From a sales construct perspective, some of our forward flow deals are structured with fixed prices, wherein we don't take interest rate or credit risk. And we also, as you know, have an incredibly diversified exit mix, wherein we don't need to overly depend on securitization markets as an outlet, and therefore we're a bit more insulated in market dislocation situations. From a hedging perspective, we currently hedge loans on the balance sheet subject to rate volatility in order to eliminate that impact of rates on future gain on sale. And then the last thing I would note as it relates to rates is, and this is what we've discussed previously, we benefit from the fact that we have a diversified portfolio of lending products that do well in different rate environments. In rising rate environments, our personal loans business does really well, and we're seeing that right now. And in lower rate environments, our student loan refinancing and home loan refinancing businesses do well. Overall, our diversified model allows us to adjust in real time and allocate capital to businesses and opportunities that we do well in, that do well in specific market and macro backdrops.
The additional thing I'd add to that, just for everyone's benefit, is, if you go back to 2018 and track interest rates throughout that year, then into 2019 and 2020, we sort of navigated an environment of rates going up meaningfully. I think at one point in 18, we were expecting 4 to 5 rate increases. In 2019, we were geared up for that. We spent the whole year really putting in place the right marketing channels, the right distribution channels for our loans from a whole loan standpoint and ABS standpoint, in addition to our funding costs and our pricing capabilities, prepared for that. When we got into 2019, I think there was maybe 1 or 2 rate increases, and then the market completely switched, not unlike we started hearing about today. And we were able to pivot our business to go to those areas that benefited from a flat rate environment. And then again, during COVID, when rates went from, I think Fed funds was at 1.5% rate to 0, we pivoted again. So we're not always going to be perfect. We'll make our mistakes, but having navigated through that volatile environment in the past gives us great sort of playbook to navigate in the future.
Come on, ask some better questions.
Thank you for your question, John. Our next question comes from Ashwin Shivakar of Citi. Ashwin, please proceed with your question.
Thanks.
This is the City guy. City. This is City.
Wondering if you could kind of walk through the guidance assumptions by segment in the cadence on that.
What the hell do you say?
Yeah, absolutely. I can take that one, Ashwin. So we aren't providing specific segment or product level guidance or quarterly progression guidance at this point. But in order to help bridge you from where we are from a current run rate perspective to our full year guide at the revenue level, there are a few things that I would call out. First, there are several businesses or factors that are not in our current run rate, but will have much more of a meaningful impact beginning in Q2 and beyond this year. That bucket includes, first, a return to normalized pre-COVID student loan refinancing originations once the moratorium ends. And we've quantified that Q1 lost revenue and contribution impact for you as part of our guide. Second, we expect to be fully originating loans in the bank and benefiting from a lower cost of capital by May of this year, and the extended hold period benefit a few months thereafter. And then third, we'll have contribution from Technisys following the close of the transaction. The second bucket to consider is continued growth across all of our segments. Within lending, I just mentioned the student loan refinancing business, but we also expect to see continued momentum in our personal loans business as rates rise and folks look to refinance out of variable rate debt into attractive fixed rate loans. And we continue to improve our overall funnel conversion, which has had a really strong impact on growth in the last several quarters for us. We also expect to see strong growth in our home loans business as we move beyond third-party throughput issues that I talked about in my prepared remarks, and continue to scale our overall purchase and jumbo programs, as well as continue to capture a large opportunity that we have with our existing member base. Within financial services, we're expecting to see continued growth in products and monetization. And the things that are going to drive that monetization are increased assets under management in our invest business, increased spend on our money and credit card businesses, as well as new product releases, premium services, and scaling our ETFs.
Just quickly hitting on some of the higher growth drivers within financial services. In money, we generate revenue, as you know, from net interest income and interchange. Given the spend behaviors that we've seen over the course of the last several quarters, as well as the expected growth in accounts that we're going to get now that we can offer a competitive interest rate, we're really optimistic about being able to further drive monetization here. In invest, we generate revenue from a number of sources: net interest income, share lending, payment for order flow, digital assets. More recently, we launched margin and soon to be options. And all of those are driven by assets under management. And we expect continued growth here as our AUM per product trends continues to do really well and our member base grows. And then in credit card, we generate revenue from interchange and balances and are really optimistic about recent trends that we've been seeing here, particularly around spending. Collectively, the reference trends that I just talked about are really helping drive growth in monetization. And you can start seeing that play out in the actual numbers. In Q4 alone, our overall revenue per financial services product was up more than 2x year over year and nearly 40% sequentially. And then the last thing I'd call out as it relates to the segment forecast is within the tech platform, we expect continued growth in accounts, transactions per account, growth in new partners, and obviously the combination with Technisys to really help drive growth there in a high margin segment.
Got it. Okay. And just a clarification, are the Pagaya loans included in the personal loan originations number? And perhaps you could use that as a stepping off to talk about, future partnerships such as this that might be in the pipeline.
Yeah, and for the benefit of others, Pagaya is a partnership that we entered in as it relates to people outside of the credit box that SoFi underwrites. We only approve about 30% of our personal loan applications because we're focused on prime borrowers, not near prime or subprime. When we first, arrived here 4 years ago, we built a strategy which we called the decline monetization strategy, which was a way of taking applicants to SoFi and sending them to other underwriters, and we get a lead generation fee, and we do that through Lantern. We wanted to build on that success and contribution to our business and help satisfy even more people that are applying for loans. And our Pagaya partnership, think of it as a lending as a service. It's completely integrated with our application process. The credit and approval pricing models are run simultaneously. The loan is underwritten by Pagaya and a partner. We do not take the credit risk on that paper. We do the servicing on that member and offer them other products and services. This was our first quarter where it contributed to the financial services revenue number because it is a referral revenue fee and a lending as a service fee.
The EPS beat by 1 penny.
About the loan volume, it's not included, correct?
No, we don't disclose the actual loan volume. What you'll see in the disclosures is the number of members that are attributable to Pagaya, and you can see that in our financial services segment, but we outline that in the actual disclosures.
Oh, man.
Thank you for your question, Ashwin. Our next question comes from Betsy Grusek of Morgan Stanley. Betsy, please proceed.
Oh, Morgan Stanley, $20 price target right now? They cut back.
Betsy, can you confirm that your line is not muted? Okay, in the interest of time, we're going to move on. Betsy, you can re-enter the queue.
Bye-bye, Betsy. Bye-bye.
Our next question is from Moshe Orenbuch of Credit Suisse. Moshe, please proceed.
Credit Suisse, they suck.
Great, thanks. So, Anthony, you talked a lot about, and Chris, both of you, about the marketing efficiency that you're seeing, lower CAC, and you spent maybe $15 million more in marketing. Could you talk a little bit about how you're thinking about the 22 plan in terms of both marketing efficiency, how much you'll be spending, what it means for the growth rate and the incremental margins?
Yeah, I can take that, Moshe. So like I said, we have made really good progress in terms of overall efficiencies. What I would say in terms of the overall outlook, we're not going to provide it at the segment level or spend level detail, but what I would say is we're at the level that we currently need to be at in order to support our longer term 30% margin target at a consolidated level. As you know, we're right now at the right unit economics within our financial services segment.
and we're seeing really strong cross-buy trends, as we alluded to, where we're starting to feel comfortable about shifting more marketing dollars towards those lower CAC products.
Got it. Thanks. One of the things that we've talked about over the last couple of months as you've gotten the bank closed and up and running is the ability to use that as a tool to get direct deposit customers. I know that you just launched the deposit suite of products relatively recently, but could you talk about any progress there in terms of getting into direct deposit for the SoFi Money customers and what that means, for engagement?
Yeah, it's still early days, and I would also just emphasize it's not something we're just starting on now. It's really something that we started to emphasize throughout 2021, and we're starting to see the benefit of more and more each quarter. The numbers are small; they're increasing very nicely. The number of direct deposit accounts that we've signed up per week increased 50% from Q3 to Q4. And another 50% from Q4 into Q1 already. And we obviously just started to introduce the interest rate and the marketing. One of the things that I'd say about the direct deposit activity is that once it does begin, you do see the pickup in spending, which Chris alluded to. So the increases we're seeing are steady and positive and to the right. But we're really just getting started. One of the things that may not be obvious from the outside looking in is that when the Federal Reserve approved our bank license in January, we had to go through a whole product launch. We had to switch the technology, we had to switch the reporting, we had to change all the marketing collateral, we had to change all the relationships with affiliates, and that process is still ongoing. So it's not like you just flip a switch and all of a sudden all the things that was driving your business before can now drive this new product and service called SoFi Checking. It really was sort of a close down SoFi Money and stand up SoFi Checking or Savings. And since we have over 1 million accounts as it relates to our money product, which we disclose, we had to do that process in a very coordinated fashion. I will give the team a ton of credit. It's been executed incredibly well, knock on wood so far. But we went through a product rollout as if it was an entirely new product, launching it first to our existing members, and then slowly rolling it out to new members. And we're just now actually switching over a lot of the marketing collateral with affiliates, et cetera. But in terms of the direct deposit initiative, it just didn't start in February. It started when we launched 2-day early paycheck. It started when we launched overdraft protection. It started when we launched autosave. And it's been a continuous process. So really strong growth in Q3.
SoFi,
Q4, 50% higher direct deposit adds per week in Q4 versus Q3. And right now, we're up another 50%. The numbers are small, but it's contributing, as you see in the financial services revenue line.
I don't think I got him yet.
Thank you, Moshe. Our next question is from Mihir Bhatia of Bank of America. Mihir, please proceed.
Damn shorts.
Great, thank you. Thanks for taking my question. I wanted to ask about Galileo, specifically maybe in the technology platform. I appreciate that you're not giving, guidance by product, but maybe you can just talk about a couple of things within that platform, just overall from a growth perspective. Maybe just give us some expectations on account growth in that platform. And specifically, the two things I'm hoping you can address have to do with stimulus, the impact of stimulus on account growth at neobanks, if you're seeing any impact from that, and just the competitive backdrop and any major contract renewals that you may have coming up.
Yeah, I think it's important to contextualize for everybody. The Galileo business is probably not that well understood in terms of how the business drives growth and what the growth opportunities are. So let me just frame that at a high level first. We're absolutely benefiting from the sector transition of physical payment to digital payments.
SoFi is still going up.
The entire business, and that's the sector trend behind it, whether that's B2B payments or consumer payments or B2C activity.
20.5.
Here are the growth drivers. First is the growth of accounts of our existing partners. So that's the 100 million that we reported this quarter of enabled accounts. That continues to grow from existing partners. That 100 million accounts that are enabled, we can provide new products and services to that installed base of Galileo's partners. And we have a very robust pipeline to add new products and services to the existing accounts, things like secure debit, dynamic fraud protection, and a number of other products that you'll see us introduce throughout the year. So the first driver is the growth in those accounts. The second driver on top of that is new products against those accounts. And then, of course, underlying all of that is just the increased activity within each one of those accounts. The second sort of bucket of drivers is growth of new partners. Some of the new partners we announced there are a good example. H&R Block with the consumer app called Spruce is an example of a new partner, and we added 44 new partners, entirely new partners in 2021. The third growth driver is international. We have 4 of the largest neobanks as partners in Mexico. We're expanding into Colombia. And now on the back of the acquisition of Technisys, we can enter another 12 markets that they're already in and operating in.
1350.
So international expansion is another bucket. And within that bucket are the first 2 buckets as well. And the last thing I'd say is that we continue to diversify our relationships. The business was built on the back of B2C or consumer neobanks, but increasingly we're much more attractive to enterprise businesses, and we'll have a competitive advantage in some of these cases. Enterprise businesses use commercial BINs, while SoFi also has a bank. So SoFi Bank could be the sponsor bank to commercial partners, enterprise partners, and have a 10 to 12 basis points advantage because we are the sponsor bank on top of the fact that we're also a payment processor. So we're really excited about the organic growth opportunities at Galileo. Without a doubt, some of the same store customers will face, stimulus, tough comps, et cetera. And our goal is to overcome that through all these other growth drivers. And that's what we're focused on, and our outlook reflects it. So we absolutely understand the headwind that may be there for some of the existing partners, but we have a bunch of other tailwinds to continue to drive strong growth there, not to mention the increased growth opportunities from the partnership with Technisys and vice versa.
Thank you. That was quite comprehensive. Maybe just switching gears a little bit. I was curious about your guide. Your EBITDA, effectively, you're going from 5 million to 60 million ramp. I understand some of that is clearly the student loans coming back, and we saw the Q1 impact of that. But maybe just talk about some of the other factors driving it. Is it just scale? How much is there a way to break out how much benefit you get from the bank charter versus just revenue growth and scale driving that?
Yeah, absolutely. In terms of your overall question on how to bridge from where we are today in terms of
ripping.
$0 to $5 million of EBITDA and 180 for the year, there are a few things I'd call out. Similar to what I said on the revenue guide, there are things that will start contributing more. As you pointed out, the student loan refinancing moratorium, the bank will also start contributing more at scale towards the end of Q2 and thereafter. And then you're also going to see good growth across our higher margin businesses, specifically our personal loans and Galileo. What I would say in terms of quantifying the overall impact of the bank, I want to reiterate again that we just opened it a few weeks ago in February, and we capitalized it with cash, not loans. The reason that's really important is because that there were 0 loans in the bank as of day one, and we just started originating loans within the bank. We expect to be fully originating those loans by the end of May of this year. As a result, the cost of capital benefits will start occurring in Q2, and the extended hold benefits will start 4 to 5 months thereafter because we're already holding loans on the balance sheet for 3 to 4 months. If you were to assume normalized pre-COVID student loan refinancing originations and continued growth in our personal loans business, as well as an extended 3-month hold period and relatively conservative cost of capital savings assumptions, the impact would be about $70 to $75 million of revenue for the year and $20 to $25 million of adjusted EBITDA. That's what's currently embedded in our guide today.
Thank you, Mihir. Our next question is from Dominic Gabriel of Oppenheimer. Dominic, please proceed.
Hey, great. Thanks so much for taking my questions. I just want to go back to actually, and you covered this a little bit, but I want to go back to the average revenue per product in the financial segment, which was much better than I was modeling and really strong. Maybe you could just go back and talk about the mix of financial products within the segments and how that mix really changed in the quarter, and which products you think are, getting adopted perhaps faster than you would have expected or a little slower by your customer base on a cross-sell. Any color around those metrics would be really, really helpful. Thank you.
Yeah, I'll hit on the financial component and I'll turn it over to Anthony. But overall, really good traction in the financial services segment. We ended up driving $22 million of revenue in the quarter. That was up 5x year over year from the $4 million that we did last Q4. So an $18 million improvement. Where that growth ended up coming from was our invest business, which contributed about 32% of that growth. Our money and credit card businesses combined delivered $8 million on the quarter and contributed about 42% of the growth. And our Lantern and Pagaya businesses delivered about $6 million of Q4 revenue and contributed to about 22% of the growth.
In terms of the performance of each of the products, I'm looking at the net adds across each of the products. And I would say at a high level, it was a strong quarter across all the products. It would be hard to pick out one product and say it was not growing as fast as we'd like. We had really, these are all disclosed and you'll see them in the 10K. We had a really strong growth in the money product and on an absolute basis and a relative basis, really strong in brokerage and in crypto, as well as robo. I think of those products, the one I think we could differentiate a lot more. They all have opportunities. We're focused on fast selection, content, and convenience, as well as making the products work better together. But of those four that I just mentioned, robo is the oldest of the four products and one the team is interested in differentiating more, and we think there is a big opportunity there to do so. That doesn't mean we're not going to differentiate on brokerage and launch options, which is down the road, or do other things on money as it relates to high yield savings, et cetera. There's still opportunities in every one of the products. That's the one we've probably invested the least in. It's still a big opportunity. I think about credit card and our at work product and international. And I would tell you credit card, I think, is a huge opportunity for us. The team has done a phenomenal job. I talked about the trends we've already achieved, but we've really just scratched the surface. We have one card. It's not segmented by different types of clients, different types of members. You have spenders. You also have revolvers. There's a lot more personalization we could do with the credit card. And there's also an opportunity to make the credit card work better with all the rest of our products. So we're excited about the opportunity in financial services products. The trends are really strong in the fourth quarter, and it'd be hard to pick out one or another of underperforming. But I do think that what I characterize are some of the opportunities to take some of the products to the next level.
Great. You kind of led me straight into it with credit card. That is a huge opportunity. It can really drive the ARPU significantly higher compared to some of the other products just by its nature. And so I was just curious about, what is the target audience when you think about the average FICO score? You mentioned prime on some of the other products in particular, and just how you think about the life of low loss rates that you would be targeting for these products as you ramp it up. Thanks so much.
Yeah, the credit card product is still a prime product with very high FICO score, over 700. We think there's a lot of opportunity to play in that segment with differentiation within it. Over time, we could explore different opportunities for a broader member base, but, we sort of have all these cylinders going at the same time, and it's constantly a debate between, are we doing enough? Are we doing too much? Are we doing enough? Are we doing too much? And I think we have the right balance as it relates to credit card. We want to build a high quality card base. We want to drive strong engagement, and we want to make sure we have great product market fit before we step out of our comfort zone. So there's still a lot of room within the prime customer that we have, and no reason to change. We can differentiate within that still.
And in terms of CECL reserves, Dominic, you can see in our filing that we're running at about a 5.5% loss rate right now, which is relatively consistent with our personal loans business.
Smash the like button, please. Get it up.
Thank you, Dominic.
Get us up.
We're currently at the top of the hour,
Get us to
so we do not
1,000.
have time for any additional questions. So I'll pass the conference back over to Anthony for any closing remarks.
Let's go.
Thank you, and thank you all for tuning in today. Before we wrap up, I wanted to share some final thoughts. The road to this point at SoFi has had its share of unexpected twists and turns, and every single time our team has shown the grit, the perseverance, and cohesion to navigate through the fog of uncertainty to achieve our goals and come out stronger. Not only have we managed to exceed our already ambitious goals, we've accomplished more in 1 year than most companies achieve in their lifetime. As we've turned the page on 2021, 2022 has started off with an even more volatile environment with greater uncertainty. The fog of uncertainty excites me. It creates the greatest opportunities for those who dare to win. It's when leadership matters most because it's when the winners who will take the most are decided. I love our team. I love our strategy. I love our company, and I love where I work. I wake up every day trying to be a better leader than the day before and reminding myself that who dares wins. For the first time in 4 years, I also wake up every day knowing the only thing between us and realizing our ambitions is us. I would take that setup any day of the week and twice on Sundays. Thank you for your time today, and we look forward to addressing you next quarter when we report Q1 results.
That concludes the SoFi Q4 2021 earnings conference call. Thank you all for your participation. You may now disconnect your.
Let's go, man. Let's go. Man, we smoked that, man. Holy crap. That was awesome. Questions were decent. I'm sure some of the good analysts weren't covering the stock today for some reason, but it just looks like a big thing that's hitting us is those darn student loans. You heard what they said. It was a $30 to $35 million hit that they're taking. Guys, if we got that 30 million in Q4, I mean, we're blowing out revenue. We're up to 320 million in revenue. So guys, is there truly, like, I had student loans back in the day when I went to college. I paid back my student loans. So I know this is a tough time because of the pandemic, but is the pandemic over? Is it over? Like, should we be extending out the student loans for 2+ years? I mean, I understand, some people can't pay it back, but it has been an extremely long time. And I would be blown away if it gets extended past May, That's gonna drop SoFi's guidance, but I think it should be Biden, yeah. Biden will extend it till election. I don't know what the reason would be for. I mean, I haven't heard anything about, COVID in, a couple of weeks. It's all war. So they don't even care about COVID right now that it doesn't sell. So it's a big revenue stream for SoFi. You could hear 30 million on a quarter, 35 to 40. And yeah, so I don't know if it's going to get extended. I hope it doesn't get extended in May. So we're getting 1.57 billion guidance, even with a 5-month extension, guys. So think about that. For the first 2 quarters, we could have easily been at 1.65 billion in revenue, if we were just in a normal environment, had part of the business back. So that's just something to understand. They're blowing out guidance with a portion of their business, pushed back, So that's something to think about, okay? Something to think about, okay? Could have easily been into the 1.6, 1.7 billion range. So I go on Biden's Twitter and I see thousands and thousands of kids saying free debt, free student loan or whatever. And I'm just like, man, aren't you supposed to pay it? It's important to pay it back just to teach you stuff. So just something to think about. I don't know, but that's really hindering 100 million and 150 million in revenue or something like that. So, but they definitely got a lot of customers. I mean, 550,000 or something like that. That's absolutely insane. They were predicting 3 million. That came in 3.5 million. That's absolutely ridiculous brand awareness that they're getting. And we might actually get a pretty good member growth for Q1 because we had the Super Bowl packed in and a couple of playoff games. So that's just something to think about as well. See, somebody's saying, is it COVID or pandemic? What are we freaking out about now? If this war, ends next week, what are they going to talk about next week? If there's no war, what are they going to talk about? They're probably going to just start peeking into certain cities and states and start putting the fear with COVID again. Okay. It's nonstop right now. Like I've said in my last couple of videos, COVID, inflation, and now war. The war headline has taken over COVID. So now it's just inflation and war. If war goes away, we might be back to COVID. I'm not exactly sure. So just something to think about, okay? There's a lot of volatility, like Noto said, even 2022, with this war popping up, the volatility is just not stopping. So what I'm looking for by the end of this year, what I'm personally looking for, that's why I keep buying SoFi. I'm looking for just a little peak in inflation, okay? I just want to see, if we go higher, let's say we go to 7, 8%, I just want to see it go down. I want to see 6% or 5%. I feel like that is going to, make people go extremely bullish. I just want to see a peak in inflation, okay? It doesn't have to go to 2% anytime soon. Can we just get it to go down a tiny bit? That's what I'm looking for. And that's why I continue to buy at these levels, because I think even though inflation is insane, I still think SoFi and these other fintechs are worth more money than they're being priced at. I mean, you're talking inflation's high. That doesn't mean a company should lose 70% of its value. It's just a lot of short interest, a lot of puts, a lot of hedging, a lot of, money managers coming out of anything growth and playing it extremely safe. The money will continue to rotate back in if these fintechs keep producing these types of numbers. So, okay, so yeah, this guy said inflation will come in higher for the next 2-3 months. Completely understandable. I just want to see a peak by December. That's what I'm looking for. Okay, I want to be, and I think growth stocks can still go up even with inflation going up. It's just there's a lot of ups and downs, a lot of volatility. Okay. Okay, let's just read through some of these comments. I'm just gonna scroll up a little bit. All right. It's all about trying to buy votes. Exactly. Okay. I think he's going to realize that the pandemic is literally coming to an end. I do not think they're going to extend it. I think someone's going to, I don't know. I think that it's not going to go further than May. That's freaking ridiculous. That is like 2 years and 3 months or something like that. I don't know, like 2 years. Let's see. What's next? No mortgages, no credit cards? Exactly. Is it COVID or pandemic? Media, worst enemies. Exactly. Russia's sanction causing worse inflation. Yeah, guys, I don't even want to drive my car to the gym or get food. I'll freaking ride a bicycle. I'm not paying $3.50, $4 for gas. I'll freaking walk. That's insane. Let's go. Okay, let's see. I think Biden needs war for his reelection. The shorts will attack to tomorrow. Guys, the shorts are freaking break the short interest down. Q3, it was about 10%. Q4 heading into these earnings 2 weeks ago, it got up to 22%, but there was some short covering last week that dropped it to about like 17%. And I think today the short interest is going up. So the short interest actually went from like 17 to like 17 and a quarter. So they were actually increasing their shorts. So right now, we don't know if the shorts are hedging, if the shorts want to continue to keep the stock down to accumulate, or if the shorts just want SoFi to fail, like just hate innovation. So it's just a mixture of 3 people shorting. You really don't know opinion. But the thing is, the higher SoFi can move up in value, the more expensive it is to short. And they'll eventually move on to other stocks that are cheaper, some other stocks that are $4 or $5 that don't cost anything, and just short those for a year. So the higher in market cap value you get, the more expensive everything gets. So that's why you see mega caps, their short interest is 2%, 3%. Go look at all the FANG. I guarantee you all of them are 1 to 3% short. So that's just something to think about. What do you think it'll go tomorrow? Oh my God, I don't know. I can tell you today was a terrible day. The NASDAQ was down 2%. I was trying to read like the headline of, why the market was down 2% today. And I guess it's the war. I don't know. I don't know. Like we rallied when the war started, and now we went up a couple of days ago, and now we're selling off because of the war. Guys, it's just nonstop. Yeah, I guess it's the war. I can honestly tell you, I'm trying to stay off the TV. It's just they just milk whatever is going on, So I don't think that's a reason to sell, because these American companies are freaking thriving right now. So the valuations are ridiculous. So yeah, oil's going higher. I mean, think about it. People are buying oil right now at 7-year highs. That's not really a smart investment. You could probably milk another 5 to 10% gains, but I'm telling you, people are going to get destroyed, if oil does come back down in the next couple of months. So people are just FOMOing to what's working, energy and inflation, and they still really haven't bought where the real opportunities are. The real opportunities are in like superior growth stocks, innovation, fintechs, and stuff like that. So it's just something to think about. Okay. I just don't think, the big money just is not confident yet in the market, mainly because of inflation in America. And, we just got 2 headlines right now, okay? 2 headlines. So let's see. 16, if we can bust through 1380. I'm going to be honest with you guys. The technical analysis and the resistances, I am not very good at that. But someone says, we could bust through 16 if we get through 1380. So I'm not sure. All I can tell you is the short interest is ridiculously high. I mean, very, very expensive shorting right now. Let's see. Mentioned oil supplies are opening. Millions of barrels are being added. Cyber attacks are next. What is your take on tomorrow's price? I am really not sure. Shorting oil. I mean, today's an incredible day. I remember the last earnings report, guys. The last earnings report was solid. We were up about 17%. So this earnings report, we're up even higher. But man, we're just the level we're at. I mean, the analysts right now got us at like a $19 price target. I'm telling you right now, the price targets are going to go higher. I mean, we should be getting close to $25 average, in my opinion. We should also get more analysts covering the stock. So I think the analysts right now is, what is it right now, guys? 11 or 13 analysts covering the stock? 11 or 13? I think that could jump to 15 analysts like literally in the next month. So the more analysts you're covering the stock, more people are going to invest. More of the insiders are going to continue to buy for those, analysts, wherever they work for. But I mean, I'm just impressed with the guidance. I told you guys on my Twitter I was expecting 1.6 billion in revenue just because of the Pagaya partnership and the Technisys and also the margin investing. So, they could easily hit 1.6 billion in revenue. SoFi likes to exceed guidance. So, 1.6 billion would have been like the extreme top end of, the 10 analysts covering the stock. So 1.57 is pretty dang good. And that's without the student loans taking away $100 million plus in revenue. I mean, can we just get back to a normal environment where, people just start having to pay back for their stuff and, not, can't blame COVID forever. It's time to man up, start paying back, some of that debt. So I really want to see that revenue come in for those student loans. Okay. I really want to see that revenue come back in. I paid back my student loans. So that's why I can have an opinion and I can say everyone should pay it back. That took out a student loan. I don't care if you went to a private university, you made the decision to go to a private university and, get charged $20,000 a year. Okay. You should have went to community college and did a transfer. Okay. You got to make good decisions. And if you took out debt, you got to pay it back. Mizuho gave us a $17 price target right now. I thought they were already at 17. That's not that good. That's kind of sucks. Let's see. I want to see Kyle spit out some super bullish targets like the old days. Let's say people literally voting for Biden because they think he will cancel the student loans. He's trying. I mean, definitely can get a lot of younger voters for him. I agree paying back student loans, but I don't agree with the interest rates. Okay, agree pay back your loans. Well said. Yeah, guys, I'm telling you. Another thing is, someone commented on Ebitda. They were like 190 Ebitda. I was telling everybody, I was looking for 400. It just looks like the bank charter, the approval of when it went through. It's just a 3 to 4 month delay for everything to get going. Okay, and that's why you're seeing the Ebitda, at 200 million. But still, think, what did we finish this year? 40 million. Do 200 million divided by 40 million. What is that? 40. That's a 500%, increase in Ebitda, guys. Their Ebitda is going up 500%. So that's really good. Imagine if we would have got our bank charter license in 2021. Okay. That's something to think about as well, guys. So SoFi is really fucking killing it. Okay. If you haven't figured it out, they're getting hindered by things that they have no control over. Okay. Student loans, bank charter license approval. This stuff is out of their control. Imagine if they would have got this stuff, back, like the student loans, let's say started January and the bank charter approved in 2021. Guys, we'd be looking at freaking 1.75 billion in revenue, I mean, they would have absolutely destroyed their 2020 investor presentation. What SPACs do you really see out there? What SPAC stocks that went the SPAC route do you really see out there pushing their guidance up? Okay, that's like less than 5% of SPACs pushing their guidance up. SoFi's pushing their guidance up, getting businesses, revenue taken from them, okay? Student loans taken away. Bank charter taking a long ass time. Look what these guys are doing, okay? Price targets are at 20 because these analysts know what's going on. There's just a lot of short interest in this market right now, okay? So I think they're killing it. I think this stock is going to be a freaking winner in 2023 if like student loans go not student loans, if inflation goes down, no war, I think this stock could go absolutely bananas in 2023. I still see great upside in 2022. I think the stock could easily, surpass $30 by like New Year's or something like that, which is still, that's a long time away, guys. That's like 9 months away. Okay. But I think this is going to be a $30 stock very easily, just off what they're saying. It looks like they're continuing to hire really good employees. I think the stock-based compensation is a pretty high. It's going to be like 370 million or something like that, 350 million. So they're paying some big bucks to set themselves up for success. When the bank charter gets rolling and stuff like that. But guys, I mean, it looks like management is doing everything correctly. It's just everything needs to take a little bit of time, okay? The Technisys Galileo stack is going to take a little bit of time. The bank charter is really going to have no impact on Q1 at all, for the EBITDA and stuff like that. So I think we should be higher off of just what we're doing now, but I think we're going way higher into the future, okay? They're killing it, okay? The members are ridiculous. They could add new businesses, somebody was talking about car loans and stuff like that. Options trading, that's more revenue, okay? I mean, freaking 90% of Robinhood's revenue is from options. So imagine how many customers we can gain if we develop a nice options trading platform, okay? A lot of things are looking good, okay? I really don't see a lot of bad things to talk about on SoFi's end. I think there's just some, problems that is out of SoFi's hands. So that's just something to think about, okay? SoFi's killing it with what they have right now. They're killing it, okay? So let's see what we got here. Okay. Up 23% after hours. Okay. So we're still going up. I told you, look at my Twitter. I said we're up 10%. I said, this is what I said on my Twitter. If you don't have me on Twitter, okay, I said Q4 was solid. Okay, I didn't say it was a blowout. I said it was solid. I said member growth, ridiculous. Guidance, not solid. Guidance was freaking pretty dang good in my opinion. So I said just wait for the earnings call to come out. And as you can see, SoFi's killing it. We're going up. We went from 11% now to 22%. Okay, so it just takes a little bit of time. Man, they really tried to screw people on the before the earnings even came out. If you guys really look, because I like to watch the stock dipped 7% right before it went up 10%, guys. These guys are crooks, straight up fucking crooks, manipulating the SEC. They can't do anything about it, guys. And if you want to know why the SEC can't do anything about it, it's because there's 6,000 companies that they have to track. They're not going to be able to track daily short, daily wash, daily covering, daily buys and sells. They can't do it, okay? The SEC, the only way they're going to be able to catch these guys are on like filings month over month. They're never going to catch these guys doing all these illegal tactics with computer algos trading, feeding off the NASDAQ daily. If the NASDAQ dips, 40 growth stocks in the fintech sector have to dip with the NASDAQ. That's just a computer brain triggering sell orders because of the overall NASDAQ, okay? So there's plenty of illegal stuff. Nothing's going to happen unless they are blatantly watching these guys, what they're doing daily, just so you understand that, okay? The only way they're going to get screwed is if like a case is, like a they do a case or something and do an investigation. That's the only way these guys can really go to jail, just so you know. Okay, so nobody's going to get in trouble. They're going to keep doing it. You just have to have more buying pressure than selling pressure. Okay, analysts are clowns. I'm going to say they're clowns because they're following each other. Okay, as soon as the first person cut their price target, they just follow each other like little weasels. They just keep following each other. Oh, this guy's 20. Oh, he's 18. Oh, let's go to 4. The Goldman Sachs guy, what is he? $13 price target, $14 price target. He has no stars. Why is Goldman Sachs letting him cover SoFi? Michael and you, if you're out there, you are terrible. You should be scrubbing the toilets for Goldman Sachs. You should not be covering stocks. You're ranked in the 99 percentile backwards. So you're in the top, you're in the bottom 100%. I don't know how to say it, but you should be scrubbing the toilets, not recommending SoFi. So they might just be using you to ruin your, complete, price targets. Goldman Sachs might be using you, I don't know, to just accumulate more, but the price target you get or giving us is ridiculous. Stop covering the stock and, go to like scrubbing the toilets or something. Let's see. They're very conservative on the 2022 guidance. That may be another statement. Okay, we might be coming in hot. We might be coming in 1.6 to 1.7. That's a blowout from 2022. We could see 60% growth. So, SoFi likes to beat. They do like to beat. As you guys can see, 2 double beats back to back. So start to believe in this management. I'm tired of reading these comments. They're going to blow out EPS and miss by 30 cents. Guys, their EPS was perfectly in line. Okay, these guys are freaking bankers. Chad Boren is the president. He was from USAA, Amazon, Tesla. I mean, they came over to SoFi because they see an opportunity, a market that is not been disrupted yet. Okay, that is why you see these leaders coming over to SoFi. Okay, so that's why you're seeing them pull these type of guys from Amazon, Tesla, and USAA, Twitter, etc. Okay. So let's see. How big is CEO actually? CEO is great, guys. The CEO is absolutely amazing. He's working with what he has. Okay, he's not forcing anything. He hasn't missed his last 2 earnings reports. He's giving you guys, good guidance, and he's trying to beat the damn guidance. Okay, what else can you ask for? Okay, we almost topped out 1.6 with freaking student loans, freaking vanished. Half the revenue stream. All right. 93 million volume today. Exactly. 93 million volume today. No freaking price moving up. The short is ridiculous. Yeah, Michael NG should be ashamed. He should be ashamed that he's, screwing people and, manipulating the damn price targets, right before an earnings. Let's see. While the retail investors sold, institutions were buying. Yeah, and guys, I think a lot of banks could be. I think a lot of banks could be shorting, but I'm telling you, there's institutions that aren't banks that are actually investment firms. And I think those are the guys that are really accumulating hard. As you can see, like what were they called? SoftBank. They're a bank, but they're not. Freaking in America. Okay, and they're all in. And who else was it? Vanguard. They're more investing. And then who else was it? Price T Row. These aren't necessarily banks that are, got the heaviest investments. Okay. Let's see. Okay, the banks are closing their inventory. Yeah, guys. I can't remember how many it was. It was like 3,000 to 4,000 banks closed last year. Of course, that was part of COVID, but it's also because it's pointless. The real estate is pointless when you can have an all-in digital bank. So more banks could close this year. I do not see a buyout at all. I don't think anyone is going to come anywhere close to what, Noto would even sell. And I don't think he's going to sell because he wants to take it to, over 100 billion market cap in the near future. So, all right, guys, you could drop some comments. I don't know if you want to like talk about revenue growth, user growth, EBITDA margins, bank charter timeline impact, student loans impact, I didn't really check the cash on the balance sheet. I know they got $9 billion in assets. If you guys look at their assets are going up and their liabilities are going down, so that's something to something to think about. CNBC talking about JP Morgan about God, I can't stand CNB. Just stop talking. Those guys are all clowns. It's not gonna happen. Okay. Noto is not gonna hand this company over to freaking JP Morgan. These guys are clowns. Yeah, I was expecting a little bit higher revenue. That's why I said the Q4 I said was solid. I didn't say blowout or anything like that. Just looks like they're really missing them student loans. That would have been a $35 million jump. I would have took them over like 315 to 320. Okay, so I think that's what you know. Revenue's still going up. I just think it's going to take some time for them to warm up their new users. To help them understand the company, all the products they offer. Remember, those are that's a lot of potential new customers that are going to be like cross buying and stuff like that, or using multiple products. Yeah, guys, I'm going to be honest with you. I was very, very confident that SoFi was going to beat their Q4 numbers. I wasn't really excited for Q4. And you guys can see the price action is not really it's not really for Q4. It's more of like the future of what they're doing for, 2022. So I really thought they were going to beat every metric. Guidance was good. Q1 guidance is still hindered by student loans. Yeah, my price target, right now, where we should be at right now, what usually happens with these price targets, I'm noticing, none of these analysts, none of them, I could give you 50 stocks, none of their price targets are hitting. If the price target is just sitting for a couple of months, they just keep dropping it and dropping it and dropping it, okay? My price target right now on SoFi with this type of earnings report, this stock should easily be over $25. The environment we're in is really killing it. But I think right now we should be over $25 very, very easily. We were literally at $25, guys, 4 months ago, and the company has made massive improvements. There's also multiple analysts, with like $22 to $25 price targets. I think they should come over 25. So I think we should be at 25 right now, but I think, we could easily see 30 plus by the end of the year. And I just think once the environment really, really comes back to a normal environment, I think we can go way higher, but it's still significantly undervalued right now. The growth is ridiculous. I mean, we're talking 57% growth for another year. Guys, look at their investor presentation. They're blowing out these numbers. So we should be definitely over $20 right now. This is very, very crappy environment around. I mean, the freaking NASDAQ lost 2% today. Yeah. Remember growth could be insane for Q1 with the Super Bowl and stuff like that, okay? I mean, we could come in right around, you know, 450 to 550 again. I think that's definitely a possibility. We're gonna have to find out. Remember, they're seeing a lot of cross buying, okay? A lot of cross buying, okay? A lot of referrals. It's just a matter of time. I refinanced through SoFi a few months ago. Easiest process ever. Future of banking, and there you guys see it. Stock compensation is insane. It is. I think it's like 350 million. Um, they're growing fast, and it looks like they're hiring some smart ass people. I heard it's really tough to work there. They push their employees really, really hard to meet, to beat these types of metrics, every quarter. So these guys are hiring pretty good. They're trying to hire the best. It looks like so. That is a lot of money. EBITDA could have easily matched the stock-based compensation if we got our student loans back a little bit, or got our bank charter a little bit faster. So something to think about. Let's see. 1 billion versus 300 million. I don't really know what that is. Student loans is a big deal, guys. We're talking 35 million smackaroos per quarter. That's why I try to tell you guys, that's a freaking $150 million a year that they've like literally missed out on. It's insane. I'm not too sure about tomorrow price. Just honestly, the price action, I think we rip higher if the market goes green, the Nasdaq. Okay, it just depends. You just heard something about a treaty or something that didn't do anything good for the market, and the Nasdaq tanked 2%. It just depends. I heard something about Russia soldiers surrendering. The headlines change daily. Get used to it. Okay. Like I tell people, what I've been recommending people to do is buy every 2 weeks your favorite companies. I'm not even saying buy SoFi. I'm just saying buy your favorite stocks that are on sale. Just buy every 2 weeks. That's the best thing you could do. Everybody usually gets a paycheck every 2 weeks. So 2 weeks is a good, averaging down. You're covering a lot of ground. Think about it. You're doing 2 buy orders a month. If the market just keeps, doing nothing, selling off, you're covering a lot of correction. 523,000 members. Nice number. Yeah. Last freaking quarter was 377. Imagine if those people really enjoy the SoFi product and they see that they have every product that they need, they're going to stick with SoFi, guys. That's a lot of members. That is a lot of members. Warrants are exercise. Warrants are everything is complete for the warrants. Okay. I don't see the government forgiving student loans, but I do see them lowering interest rates. That may hurt us. Hopefully, prior to May, SoFi adds options trading. Okay. More revenue to cover anything's out of SoFi's control. All right, guys. We wrapped it up. We answered the questions. I might do a video potentially covering like important aspects of the SoFi earnings that I really liked, and stuff like that. So I hope you guys enjoyed the live stream. Hope you guys heard what you wanted to hear on the live stream. Most important factor that I've been talking about. Once again, remember, guys, I've been covering 15 fintechs for you. 13 of them were ass. 13 of the fintechs were ass guidance. And I continue to recommend SoFi for you every single month this past Q4 because I assure you this management team is at the top tier. We're talking, Square, Upstart, they're right in line, okay? So 95% of these companies did put out pretty bad guidance. So you gotta be confident, guys. You gotta be confident and you gotta do your due diligence. If you have due diligence, you got confidence, and your confidence is gonna allow you to stick in there when things get ugly. Like today before the earnings even come out, the stock was down 7%. I was literally like freaking went to go take a piss. I was like, wow, these guys are idiots, stupid shorts. 7% drop. Earnings aren't even out. They're just trying to rob people. It's just illegal tactics they're using. That's not real emotion. That's a computer trying to screw people. So I hate it. It's just SEC will not do anything about it. Okay. So yeah, guys. So the key about this entire earnings report, of course, EBITDA jumping 500% year over year, 500% EBITDA. I told you I was looking for about 400, but of course delays with the student loans and delays with the bank charge. So EBITDA is still going through the moon, and also revenue growth is very impressive. We're talking 57% growth. That's awesome. That's like really good. Q4 once again was decent, solid, okay, for revenue and stuff like that, okay? But they did rack in a lot of potential new revenue streams for customers and stuff like that, okay? So I hope you guys enjoyed it once again. Hope you have a great day. once again, I mean, I'm enjoying this earnings because, you know, it was a good earnings, but we are way too damn low. The stock is too damn low. So that's why I'm, you know, I'm still kind of frustrated because we should not be this low. Freaking growth stocks are way oversold. Okay. Way oversold. It's just the environment we're in. So hope you guys have a good day once again. Have a drink, have some food, celebrate, and be sure to subscribe to the channel if you are not subscribed to the channel, and hit the bell notification. Be sure to smash the like button on this video so it'll go out to more people so they can see the earnings call, and drop a comment. And oh, one more thing. Hang on. Hang on real quick. Let me get my little, let's see. 1 second. Let's see what we got here. I gotta get something. Man, where the heck is my thing at? Oh man, I can't find it. Hang on, guys. I gotta grab something. Plug my video real quick. Gotta plug it. All right. Let's see. Come on, baby. There we go. All right, guys. For anybody new to the channel, if you don't have a SoFi Invest account, if you deposit $100 into the SoFi Invest platform, they're going to hook you up with $25 in free stock. So you get to increase your wealth $25 for free by depositing $100. And I will get a commission. All right. So be sure to click the link and check it out. If you don't have a SoFi Invest account, I do buy stocks inside of SoFi. It'll be very fun once they get options. They'll be able to add even more members. So, all right, guys. Stock Gold is out. Hope you have a great day once again. Have a good time. SoFi killed it.